Hi, welcome to section 3 then of chapter 8, where we're going to start thinking about the banking system. The first thing that we're going to look at then in this section on banking is introducing the idea of financial intermediation. What I want you to do is imagine that you need to buy a new car and you want to borrow, I don't know, let's say £10,000, so quite a nice car then, and you want to borrow it for, say, I don't know, 5 years. Now, I would imagine that your number one port of call for this would be to go to your bank or to a bank, and you would go to the bank and you'd ask them to borrow the money, and they would lend you the money, and you'd have an interest rate, and you'd pay interest and capital back every month then until the loan was matured, and you'd paid off the entire amount. What would be very unlikely, I hope, is that you would go down the high street in your local city or town and just try to find somebody to borrow the money from. And your thought process might be, well, maybe it would just be cheaper. Maybe it would just be cheaper for me to borrow from a random person. Now, obviously, there'll be lots of problems attached to that. And in the first example of going to the bank is acting as the intermediary. Okay, so they're providing financial intermediation for you. And what that means is you have some people in the economy that have more money than they need, and we'll call those lenders. And you have some people that have less money than they need, and that's you in this scenario. So you need more money to buy your car, and we'll call you the borrower. And the intermediary then acts between those two. And even just thinking about that very basic example of going out to buy a car, there are lots of things that the intermediary will provide that will be very useful to one of those parties. So we've got a list of 4 benefits underneath here then. Firstly, the fact that small amounts can be combined to provide larger loan packages. So what you might find is the bank has lots and lots and lots of small deposits. Okay, so lots of people essentially investing their money by putting it into a bank account to earn some sort of interest, and they tend to do that in relatively small amounts. Now, when you go to the bank and ask for £10,000 to borrow, what the bank doesn't have to do is find one person who's depositing £10,000, because they can take some money from lots of people to make up your £10,000. So that's really good. Combined with that then, you might find that you have lots and lots of short-term investors. So lots of people who put their money into the bank in the short term, but you need to borrow your £10,000 over 5 years. Again, you don't need to find people who want to invest for 5 years. The bank will just roll that money over. So somebody will deposit some money in January, and you will get your loan in January. And when the person in January wants their money back, the bank will give their money back and replace that effectively with somebody who's deposited money in February, and then March, and then April, and so on. So they can use the kind of rollover, the constant deposits and withdrawals, and they can have such quantity that they can enable you to borrow it for a longer period. Other than those 2 key aspects, obviously trying to go to a bank or going to a bank is much easier than just trying to walk up and down, for example, Reading High Street, trying to find someone to lend you money. And also, you're going to find that you've got lower risk for the investor, because it's not just one person's money that the bank is lending to you. So if you had one person lending you money and you didn't pay it back, that person has lost their entire investment, whereas the bank won't be like that. There'll be lots of people whose money they've used. So lots of good reasons for you to go to the bank for your loan. Okay, let's think a bit more detail then about these banks. So we're going to go through a few different types of bank. Then we're going to think about what they do, think about their relationship with you, and then we're going to move on to something slightly different. So primary banks then operate what we'd call cheque accounts. Now, although cheques don't tend to be used in the UK very often, we still have to think about this kind of clearing aspect, which we'll look in a bit more detail in a second. Secondary banks then would be your merchant banks. So they do not take part in the clearing system, but they perhaps service larger businesses. And then you also have kind of central banks, and obviously in the UK we have the Bank of England. Now, the Bank of England's main role in the UK economy is to carry out monetary policy and to ensure financial stability. So we'll think a bit more about monetary policy towards the end of the course in the economics chapter. But for now, we just need to consider that the Monetary Policy Committee will play around with the base rate, the base interest rate, to make sure that it meets its inflation target. And also through its Financial Policy Committee will try to ensure stability by making sure, for example, all of the banks aren't massively over dependent on this wholesale money, which leads to the bank overextending itself. Okay, so what do we mean by the clearing system? Okay, so the clearing system really is just referring to the amount of time it takes you to be able to withdraw your money from when it's paid into the bank. When I say money, obviously we're including kind of checks in that, and that's the main issue when it comes to clearing. So when we're referring to general clearing, what we're really talking about mainly are checks. Electronic funds transfer is just any computer-based financial transfer. Okay, and a BACS payment, or Bank's Automated Clearing System, is an example of an EFT. And for example, we use that for things like salaries. Whoops. For things like direct debits and for standing orders. Clearinghouse automated payment system is just a bank-to-bank transfer system, and often that's going to be for same-day payments. And then Swift is essentially a communication system, but it's pretty similar to CHAPT, but we can use that kind of for international payments too. Okay. Last bit here on the banking system is just going to be about the various relationships that customers have with their bank, and also thinking about that fiduciary relationship too. So we break the bank and customer relationships down into 4 different types. It really depends on what types of transactions you are completing with the bank. So for example, we have the debtor-creditor relationship, and this is essentially where you deposit some money and the bank borrows that money. Okay, and they obviously have a responsibility to make sure that they pay that back. The bailor-bailee refers often to, or traditionally to, the bank providing safe storage. So if you have kind of a safe deposit, the bank promises to look after that for you. Principal agent is just where the bank acts on your behalf. So the bank will act on behalf when you pay a check, for example. And then finally, mortgager and mortgagee relationship, where the bank might secure a loan over a particular asset, and if the loan is not repaid, the bank has the right to sell the asset and pay off the loan with the proceeds. Okay, finally then, the bank-customer fiduciary relationship. The bank has a list of duties that they have to enact. So as long as you make out a check correctly, and as long as you have enough money in your account, they have to honour your checks. If you receive any cash or checks that are paid into your account, they have to credit that. They have to comply with any instructions in terms of direct debits or standing orders that you put in place. They have to respect your confidentiality, and if they're going to close your account, they have to give you reasonable notice. So that's just the kind of the overall fiduciary relationship that the bank has. The bank is obviously the most powerful party in the relationship, and they have to act in good faith. Okay, that's the banking system then. Next up, in the next recording, we're going to start thinking about the money markets, and then we're going to get on to a bit more detail on the different sources of finance that a business can have, whether that's equity finance or debt finance.